Welcome to the Service to Syndication Podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, capital raisers in the world who have worn the uniform of this great country, those who provide services to our men and women in uniform, and other service-oriented professionals to provide you with the tool sets, the mindsets, and the skill sets to help you conquer your dreams and goals in real estate and to use this wealth creation vehicle so you can live a more successful, happy, and fulfilled life of generosity and prosperity. If what you desire is time, lifestyle, and financial freedom, you've come to the right place. We will bring to you the best real estate entrepreneurs who will give you the insights, the knowledge, experience, skills, so you can go out and crush it in whatever real estate asset class you desire. So grab a pencil and paper, sit back, and enjoy the ride on the Service to Syndication Podcast. Three, two, one. Hello, my servicemen and women and other service providers. Welcome to another episode of the Service to Syndication Real Estate Podcast. I am your host, Cedric Marlow. I am a U.S. Navy vet. Here on the Service to Syndication Real Estate Podcast, we interview the most successful real estate entrepreneurs, investors, capital raisers in the world, where most have donned the uniforms of our great country. We aim to provide the tool sets, the mindset, and skill sets for you to achieve your personal and business goals while using wealth as a wealth creation vehicle to help you live a more successful, happy, and fun-filled life. I am super excited today because I have with me top-notch wealth advisor, Mr. Ed Butowsky. But before I properly introduce our exciting guest to you, I want to ask a favor of you. Please, if you get some value out of this interview, if you get some type of insight, mindset shift, if you learn a new skill, receive new information, receive inspiration or motivation to go out and take some progress in your life, please share this episode with some of your friends. Send it to someone you know who might be or could be interested in real estate. Share it on your social media, post it on your wall, or share it in your stories. Help us spread our message while you help others. And for all of you who share this episode, I want to say thank you. I know you're going to get some value out of this interview, so like, subscribe, and leave a comment so you will be notified of future episodes. Again, everyone, I have with me Mr. Ed Butowsky. He is managing partner of Chatwood Investments and an internationally recognized expert in wealth management, personal finance, and how current events shape investment portfolios. With over 29 years of experience, including senior leadership at Morgan Stanley, Ed has advised celebrities, professional athletes, and private individuals on how to grow and protect their wealth. He's been featured in ESPN's acclaimed 30 for 30 documentary, Broke, the iconic Sports Illustrated article, How and Why Athletes Go Broke, and PBS's Front Lines to Catch a Trader. Known for his straight talk and hands-on approach, mentors athletes and families while also educating investors nationwide through TV, radio, op-eds, and speaking engagements at places like Yale, NYU, and the American Bar Association. Ed is also the creator of the CHIP score, a unique metric to evaluate portfolio strength, and the founder of Chatwood Investments, which provides tailored financial strategies to affluent families and individuals. When he's not advising clients on speaking, Ed enjoys life in Plano, Texas with his wife and 2 children, and is an avid tennis and golf player. All right. Ed, first off, welcome to our podcast. And the thing that I really like to do with my guests is kind of summarize your career, if you can, in 75 seconds or less, and then we can just start to unpack a lot of that.
Sure. So I grew up at Morgan Stanley here in Dallas, and all I did was cold call every single day, and I worked harder than anybody. And there's an old line, if you do things like very few, you'll live like very few. And I really believe that. So I grew up at Morgan Stanley, and then after 18 years, I got bought to go to Bank of America to their private client group. And they kind of sold me a bag of goods that weren't there. So I left there and then we started Chapwood Investments, which is an independent RIA, federally registered, meaning we have over $100 million under management. And we are customizing portfolios for individuals. It's really interesting, Cedric, that you're doing this with military officers because real estate investing and any investing is very similar to when they go out on a mission and they have to look at everything. They have to look for landmines. They have to look for sniper fire. They have to look for, IEDs. Okay.
Yeah.
I don't know what an IUD is, but IED. And there's constantly new information flowing in that they have to evaluate. Same thing with real estate and same thing with portfolio management. You're constantly evaluating information from everywhere. That's something that should do really well for service people coming into the real estate world.
Yep. Yep. I agree. So Ed, you've been a trusted advisor to celebrities, athletes, private individuals alike. What drew you into wealth management in the first place?
I didn't have a big plan in my life. I remember talking to my father and I said, I'd like to become a wealth advisor. He said, well, you can try it, but you're never going to be any good at it. And I'm like, oh, that was most motivation I ever needed. But what I love is that everything that happens in the world, I need to know about. If you ask me what's going on in India right now, I know what's going on in India. I know what's going on in South Sudan and in Asia and so on. So I have a really good understanding that knowledge is the king here, but then you have to take it and interpret it and figure out what is the best move for your clients. So that's something that I really love about this industry. Plus, you're helping people understand how they can live the rest of their lives. I'm not a doctor, I'm not a lawyer, but I'm a wealth advisor. And sometimes the wealth advisor holds a really high position in someone's mind. And that's what I love. I love being a part of in a positive way of helping people.
Oh, yeah. Yeah. You guys definitely hold a high regard in a lot of people's minds because first and foremost, everyone wants preservation of capital. Secondly, and then to grow their wealth following that. So you guys are definitely needed and sought out for definitely those of you that are staying in the top echelon in your career field.
So that's one of the issues, Cedric, is barriers to entry into our industry is that you have to memorize like 250 pages of a book and just answer questions, and then you're a wealth advisor. The barriers to entry should be much greater than that. There needs to be a higher level of complexity that people need to learn and understand about investing because you have a lot of bad actors out there and people who really truly want to do a good job but have never been trained on how to do it. That's one of my little pet peeves.
Understood. So after nearly 3 decades in the industry, what do you see as the biggest misconception people have about managing wealth?
I think they don't truly understand and appreciate the low correlation that's needed between assets. So if you have a portfolio where the risks to those investments are all the same, what you're going to get is when things are happening in a positive way, investments are going to go higher, then they'll all go down like this. And eventually you'll get a roller coaster. And what you really want is a smooth ride. And to understand how correlations work, people think that you get a lot of diversification by investing internationally. Well, the correlation between international and domestic has reached about 0.96. One means they move identically. So you don't gain a lot of diversification by being in international versus domestic. They're very, very much mirroring each other. And that's changed over the last 20 years because communication systems and computer systems have made it so the second something happens in Hong Kong is immediately reflected in New York. So you really don't gain a lot of risk reduction by investing internationally.
Okay, that makes a lot of sense. That we all know the computer age has brought the world much closer. So yeah, definitely, and especially things that's going to move economies within whatever country it is definitely going to hit right away. It's going to hit those news wires that I know you guys pay close attention to quite a bit. So you're known, like I said, for your straight talk and hands-on approach. How does that set you apart from other wealth advisors?
Well, I've come up with some investment forensics. Anybody can go to my website, chapwoodinvestments.com, and look at these calculators. I call them the investment forensics toolbox because I believe that every portfolio is a crime scene. And we just have to figure out what that crime is, how big the crime is, and what you can do to correct the crime. Because I do not believe that most people have an understanding on how to manage money because they don't manage risk because they don't actually know how to measure risk. And that's one of the things I do in my toolbox is explain how to measure risk.
Okay. You know what? I did go to your website and I saw that. I saw that up there. I was like, forensics. I'm like, well, okay, not sure what that's all about. But yeah, I played around in there. So yeah, definitely. And I think that's a great tool to have for people to be able to look at and get to know a little bit more, like you said, about their wealth and try to how to decipher it. Yeah.
Yeah, there's a lot of vagueness on how to properly evaluate a financial advisor.
Right. Now, you were featured, like as I mentioned, in ESPN's Broke and Sports Illustrated, famous article on why athletes go broke. Why do you think so many professional athletes struggle financially despite earning millions?
Well, a couple of reasons. And I was instrumental in putting that movie together. And so I'm very, very proud of the movie Broke. And the reason that athletes go broke is they put too much money in illiquid investments. So until you have $3 million put away, you should not invest in real estate, private equity, or venture capital. Once you have 3 million put away, then you should have 7 to 12% of your money in real estate and 0 to 10% in private equity and 0 to 5% in venture. But the main reason is the overspending and having money in illiquid investments where you can lose, on a venture capital, only 1 out of 30 of the best venture capital investments work like they're supposed to. So too many people are taking too great a risk. Real estate is the least risky under that $3 million level. But I always say that you should have 3 million put away before you do any of the private investments.
Okay. Now, when you say put away, what are we talking about?
In an investment account.
Okay, in an investment account. Got it. Got it. Okay. So now, what are the first 3 things you advise a young athlete or entertainer to do when, they sign that big contract?
We know you're going to like this episode, so please like, comment, and subscribe to this channel so you can be notified when the next episode drops.
Write down what their monthly expenses are. So we have a goal as to how much money they need to live off of. Because we have to assume they're never going to get another contract. If they have a contract in football or basketball or baseball, those are guaranteed. But we shouldn't manage money according to what's going to happen. We should look at what your monthly expenses are and then subtract from that or subtract from what you're bringing in after taxes, what you can put away. And we should always have about 20-25% of your paycheck going into an investment account.
Okay. All right. Now, what have you seen in terms of like an athlete's financial challenge? Does it come from like poor advice versus their own spending habits?
Yeah, it comes mainly, it's not from bad advice, because I don't think anybody wants to advise anybody in a negative way, but I do believe that it's their desire to want to have things, and that pushes them down that path of spending money. So I also have a chart that shows if you took $1,000 and put it in furniture, the next day it would be worth $250 because there's about 75% of markups. So if you wanted to go sell that, you've lost 75% of your money. And then 7 years later, it would be worth $150. And then 14 years later, it would be worth about $50 if you could even get that for it. Furniture is a depreciating asset, just like most things are. So you have to be very careful, and you have to ask yourself, if you don't have any children, imagine your child coming up and asking for a new bicycle and you saying, I can't afford it.
Yeah. Yeah. That would be definitely a hurt piece, you not being able to afford something that your child clearly deserves, Yeah, definitely. So, well, along that line, like, have you noticed the shift in how athletes and entertainers view money today compared to, say, 20 years ago?
Well, they're asking a lot more questions, which is good. I don't know if they listen to the answers, but they're asking more questions and they're being very conservative. They're putting money in money market and not investing it in the equity markets or bond market or real estate, private equity or venture. They're very scared of liquidity.
Wow. I mean, that's really good to know that, like you said, they are afraid of liquidity, and they're putting it into the money markets and things like
Well,
that.
let me correct some.
Yes,
They're scared, so they want liquidity.
they want liquidity. Okay, gotcha. All right. All right. So you developed the CHIP score, as I mentioned, to evaluate portfolio strength. Can you explain the CHIP score and why it's important?
Yes, so the two main things that hurt people is their loss of purchasing power and volatility in their stock price in their portfolio. So the chip score really highly is influenced by the historical rate of return and the volatility. So if you have a portfolio that has a rate of return of 7, and the inflation rate is 6, then you take taxes out, you've lost purchasing power. And that's what happens to a lot of portfolios. So I score it based on those factors. And then we score it based on volatility because volatility makes people want to get out of the market. And the best investors are the ones that stay in the market.
Now, in your experience, what are the most overlooked factors in building a resilient portfolio?
I think not reacting to time, to short-term moves. Like we had the tariff issue and everybody was talking about it, but I didn't make any changes and it was the right move. So I think having access to information is a real problem because it makes people want to do things when they don't need to do them.
Okay. Now, did you have clients that called you up, especially when the tariff things were going on, saying, hey, what are we going to do about this? Are we going to make moves? Are we selling stuff or anything like that?
Well, yeah, I had a lot of that. I had a lot of people call and say, hey, what do we do about this? The market's down. And I said, because the market's down doesn't mean your investments got any cheaper, just means the stock price has gone down. But your investments are still worth what they were before the tariff announcements. And, so you have to, it's really good to have a wall between you and your money. I have this one client, Rob, who didn't want to go down below a certain level. And we went down below that level and he freaked out. But now he's back up to where he was and more. So I think short-term moves is a real tough thing for investors.
And I do second that. I mean, I know that different friends of mine that, have that's in the market, they were ready to make certain moves. And then myself and another partner of mine, we told them, like, slow down, hold on, because if you sell off now you've created that loss. Where if you just stay in your position, then it'll bounce back. It's going to take a little bit, but it's going to bounce back. And now, kind of like Rob, they're very happy that they did at least listen to us along that line. So, yeah.
Yeah, I'm still waiting for my gift.
I'm pretty sure he'll take care of it. So how do you factor inflation, taxes, and fees when creating investment strategies for your clients?
Well, we obviously want to charge as much as we can because we're a for-profit organization, but there's a market. It's about 75 basis points that we charge. Then inflation is the key to my career. I always talk about how inflation is not calculated properly by the government. Because if you went back and looked at the old rules before 1983, they would look at 1,700 items every single month and just simply register how much that item went up and then took the aggregate and said, this is how much prices rose. But after 1983, they changed the way they calculated inflation to make it lower because the government was having to pay out 13% increases in transfer payments, Social Security, Medicaid, Medicare. So they changed the way they calculated it. But if you went back today using the old rules, you'll find that inflation's running between 7 and 9% a year. So I factor in the real cost of living increase. I don't even call it inflation because inflation is such a broad term. I call it the cost of living increase. And then taxes, there's certain creative things you can do to avoid some taxes, but most of the taxes are not something that you can fudge with. It is what it is.
Yeah. Outside of that story concerning Rob and the tariffs, you have this reputation of tying current events to investment strategy. Can you share an example of a recent event that dramatically shifted your advice to clients?
Well, I don't know if it's dramatic, but I do believe that oil prices are going to come lower. So I got out of all of my oil company stocks and bought something that would go up when oil prices went lower. It's an ETF called ERY.
Okay.
So I believe it's the Direxion 2 times bear. meaning that if oil prices go down, this goes down 2 times as much. And if oil prices go up, this will go down. It's the opposite. So if
Okay.
oil prices go higher, this will go down 2 times. If oil prices go lower, this will go up 2 times.
Okay.
That's something that, I took a world event, realized that the Strait of Hormuz was not going to get lowered or closed. And I realized also that Iran only is responsible for 3% of the oil that's drilled every year. So I just figured that was a good hedge to put in there.
Okay. I'll definitely be looking this ETF up a little later. So now, how can the average investor adjust their thinking to better navigate turbulent markets?
Well, first of all, I'll offer this free to anybody that if they want me to do an evaluation on their portfolio, just reach out to me at ed@chapwoodinvestments.com. But most people should look, there's online tools that look at correlations. They should put in their investments and look at the correlation. And if you have a correlation number higher than 0.85, then you need to make adjustments in your portfolio.
Okay. Okay. All right. I like that. So what trends or risks do you see on the horizon that people aren't talking about enough?
Well, I think one is the direction of short-term interest rates. I think that the GDP for this country is really, really slow, and we're going to have to lower interest rates to stimulate the gross domestic product. But that's going to inflame possibly inflation or the CPI number. So you have to be careful. So if you want something to stimulate, you lower rates, and that makes people more interested in borrowing and spending money. But if you raise interest rates, that squelches that ingenuity and that creativity and that desire to go spend money. So you have inflation, which is up here. And if you lower rates, it's going to make inflation go higher, possibly. And right now, Trump is saying there is no inflation. And theoretically, there isn't any inflation right now to speak of from the government standpoint. From real world standpoint, there's a lot of issues with inflation.
Okay. Yeah. Yeah. You see it with, different things, the supermarket especially. That's where a lot of people feel the pinch of where the inflation has taken a hold of their pockets.
And prices don't come down. They just stop going up. So let's remember that the CPI is the rate of change. So that doesn't mean that if inflation went from 9% to 5%, that inflation that prices dropped 4%. That didn't happen. That just means the rate of change went from 9% to 4%.
So true. Absolutely. Thank you for clarifying that for those people who don't quite understand the consumer price index, and how it affects prices and things like that. So again, you mentor young athletes and their families. What's the most rewarding part of that work for you?
Seeing the player retire and have enough money to live off of.
Yeah. Yeah, that's nice. That's nice. And I'm pretty sure their families are very happy behind that as well, because, we do have that penchant of wanting to spend because we think, as an athlete, you think that those millions are going to continue for the next 10, 15 years, depending on how long you play. And for someone like you to, like you say, start to curb their spending and put a wealth management program together that really helps them out and saves them down the road. So beyond financial success, what life lessons do you try to impart to people you mentor?
That there's always an opportunity in front of you. You just have to be open-minded to see it. So no matter whatever happens in your life, there's something new and there's a crack in what there has always been. Investigate it and look at it from a positive standpoint, because believe that you're blessed and that good things are going to happen to you, and that you always have to see the positive in everything.
Okay. Nice. So for parents of young athletes, what advice would you give them about managing their children's newfound wealth and fame?
Yeah, just remember the power of compounding, that if you grow something at 10%, it'll double every 7 years. So even if it's $2,000, 2,000 becomes 4,000 in 7 years, and then it becomes 8,000 in 14 years. So, always keep that in mind.
Yep. The compound effect. Absolutely. So also, what motivates you to keep educating and speaking about these topics after such a long, successful career?
I just have a desire to touch everybody and share the knowledge that I've been fortunate to gain over the years. but it's just more of an empathetic standpoint. So, Cedric, I got to go.
Okay. All right, Ed. Thank you.
Thank you.
Thanks for listening to the Service to Syndication Podcast. We want you to know that we love and appreciate your support, and we are grateful about being a part of your journey to becoming a successful real estate entrepreneur. Please share this episode with a friend who you think will get a lot out of what you just heard. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be in all areas of life. And if this was really valuable, share it on your social media stories and timelines. Thank you for watching and listening. Now go be great.